Now we see your face.
There you are.
Yeah, you should see me now.
Yes.
And see you now.
All right. This is good. All right, so I love teaching this part because technical analysis is something that we should all learn how to do. It's not complicated. It is just intimidating. So we just got to help each other figure out how to make it less complicated. So that's what we're going to do. And in technical analysis, we will be able to read the charts. We don't predict, we anticipate. Based on historical data, we will see the chart doing one thing, and then we anticipate what it will do next, and we take action based on that anticipation. If it does something different, that's okay. We were wrong, but the idea is to get it right more times than we get it wrong, because there is no perfect technical analysis, right? The big institutions, they know the same thing we know. So when they want to trick us, they will show us a signal. We take the signal and they will turn it around. And our goal is to have an edge so that we follow them instead of fighting them. So that's really what we want to do. I was saying, shameless plug, I have a YouTube channel that I recently started, and every morning I give an analysis of where I think the SPY is going. And I would love for you all to join so you can see what I am looking at every morning. I think that will help you with your analysis, and I'll put up the link later on. So the reason why I mentioned that is this morning when the markets open, I said the market is going to go here. If it's going to go up or it's going to go down, and I give different reasons based on the charts why I think it's going to go here. And today in this lesson, I will show you why I thought the price was going to go here, and this is where it went, right? So every week we see the same thing happening over and over again. SPY repeats some cycles over and over again. So we want to take advantage of those movements. There are days where SPY just has tight ranges. It's okay, we don't have to trade every day, right? We trade on days where SPY is giving us those opportunities. And you can do options and really be able to capture a lot of money with just $1 move in the SPY. That's why I love trading the SPY, and they're not expensive options either. So we'll go deep dive into that all today. So far so good. Are you still with me?
Yes, we are.
Yeah.
All right.
Yes. Let me ask you a question.
Yes.
And it's very quickly. Do you think that it's wise to look at how the other markets, like the Asian and the European markets, how they look as well to determine about SPY? Do you think that's wise?
It's always good to have an understanding of what every market is doing. It's a good thing. However, the SPYs are US markets, and they don't care what Asia did. As soon as 9:30 a.m. Eastern time hits, they're going to make their own plan.
Mm-hmm.
So sometimes you'll see the futures way down in the middle of the night, and they shoot back up as soon as the markets open for the cash market. So just have an idea, but don't make it the sole thing that you look at, if that makes sense.
Yes, that makes sense. Thank you.
Sure. So just a quick disclaimer, because I'm not a financial advisor, I have to put this up. I do this just for educational purposes, and I'm not recommending any buy or sell. I just want to share my knowledge. I just want to teach you what I know so you can make your decisions. So when I am looking at the charts, what I'm really focusing on is what I call save. And I call it save because it's easy for me to remember. And what it shows me is structure, area of value, and then execute. So what is the structure? The structure meaning, are we in an uptrend, downtrend, or sideways market? That gives me the structure. And an area of value means, where do I choose a spot to enter? If price is going up and it's at the upper boundaries, I don't want to enter more positions to go up because it has to pull back for it to continue up. So I don't want to be caught chasing the market, right? And we're not talking about investing here, right? Investing is for long term. We're talking about using daily movement to capture profits and doing trading. So for that, I want to make sure I enter at the most optimal place, and that's the area of value. And then we execute based on that. Structure, area of value helps us to execute. And by execute, it's both entry and exit. We have to know both of these before we enter a trade. If we don't know where we're exiting, then it's not a good trade. Then it's like gambling and throwing money at it. I don't want to gamble with the money. I want to have an idea. This is what I'm anticipating price to do. If my anticipation is wrong, this is where I'm going to exit. That's how I want to trade. So that's how I want you to think about it. So structure, area of value, execute. Is this making sense?
Yes.
Yeah. And feel free
Yes.
to stop me along the way
Yes.
if you have questions. So the structure is what the market tells us what it wants to do. And as we look at any given chart, we first analyze structure. And for me, I start with monthly. I look, what is the monthly doing? For example, the SPY. We're going to focus on the SPY today. It's in a very strong uptrend on a monthly. Fantastic. So then I go down to the weekly and I see the same strong uptrend. And the weekly shows me if there is a short-term pullback like we did here on February 16th. Prices started to pull back for 3 weeks and then it continued the course. And from weekly, I go to the daily. Again, daily will turn first before weekly, before monthly, to show if there is any area of pullback. That's what I want to see and be able to take advantage of those moments as the market is turning. So once I have decided and seen the structure, we're in a very strong uptrend with some areas where it could pull back. Like on today's pullback, it doesn't scare me because we're in a very strong uptrend. The markets have to breathe all the way, always, every day. They have to breathe a little bit to continue the upward movement. They don't go up forever. So this pullback for me is a breather and it's a healthy thing. If the pullback is 10%, 20%, then it's a correction. It's something else that we have to consider because that means the structure is broken. So that's why we start with structure. We start with structure all the time. So once we have decided what the structure is like, once it has told us, right, these are the next steps, we look at price. I don't like using a lot of indicators. Indicators are misleading because they're lagging. They tell us after the fact. And when we take an action based on an after fact data, then the move has already happened. We're entering too late or we're entering prematurely and we will get stopped out. So that's why I want to focus on price action. And by price action, what we look at is price making higher highs in conjunction with higher lows? Is it making lower highs in conjunction with lower lows? Or is it in a range, meaning higher highs, lower lows, higher highs, lower lows? And so when it's confused, then it's a sideways market. And there are ways to trade sideways market as well. But we can focus on those trends, strong uptrend or strong downtrend. And is there volume behind these actions? When you have a big spike in one direction, up or down, followed by low volume of opposite direction, it just means that that spike might continue the trend because that had the strongest volume. So with that, we will anticipate the next move, and we don't predict. We're not in the business of predicting. So that's very key to remember. When we predict, we start to gamble, and then that is never a good thing to do when it's our hard-earned money we're trying to grow for our future. So then once you know the structure, and the area of value means where is an area where in an uptrend the bears took charge for a while, and now the bulls are coming back to retake that charge. That's the area of value. That's where you have the highest amount of reward for the lowest amount of risk. So if we look at the chart for that, so in this example, if you enter a long position here, your ideal stop structurally is here. So that's a lot of distance to cover. But if you wait patiently for price to give you an entry like this, then when you take a position somewhere here, your stop is here. I'm sure now you can see the difference between the two entries. This is why I say area of value is really critical.
That makes a lot of sense.
Yeah. And as humans, we get a tendency, fear kicks in, and FOMO, fear of missing out, and we start chasing up here. We either have no stop and we wipe out our accounts, or we have these huge stops and we still wipe out our accounts. So as you're looking at the daily chart, this is what the structure looks like. And when you want to start trading every day, you can start narrowing down your charts, going to, for example, to 1 hour chart to decide what is the structure of this 1 hour chart. And then when I get to an area of value, which it seems like it might be giving us here, then we can use the 15 minutes to enter. So the concept is the same. For whatever time frame you want to trade, go up the next level up, which should be 4 to 5 times greater in time. So 15 minutes times 4 is 1 hour. So at least 4 or 5 times greater time frame to figure out the structure, and then based on that structure you execute. And
Can you repeat that concept again? I'm
Sure.
trying to write as you talk.
Sure. So if I want to trade the 15 minutes chart, then I need to look at least at the 1 hour chart, which is 4 times greater, to tell me the structure.
Okay.
And then so I look at the 1 hour chart. The 1 hour chart is in a pullback. Great. So I'm at an area of value. The trend is uptrend from what I see. So this is a momentarily pullback. Then I go to my 15 minutes chart, which I will use to trigger. Then what I want to see in the 15 minutes chart is the hourly and the 15 minutes are in agreement in the downtrend. But now I want the 15 minutes to break structure. Break structure meaning form a higher low and form a higher high somewhere here and continue to make a higher high.
Okay.
So when the 15 minutes breaks the structure, I can be comfortable to enter a position, right? When we break this high, I can be comfortable to enter this position because the 15 minutes will turn before the 1 hour.
I'm sorry, I had a question.
Sure.
So, and you may have already answered this, but what makes that area the area of value? Like what indicator, what is the indication that says that?
Okay. It's a good question. It absolutely does make sense. It's a very good question. I have not really touched on that yet. I'm just giving you the concepts because I'm going to go these yellow shaded areas. I'm going to tell you why I drew them, why they're important, why I think they're area of value, when I mentioned this morning, why I thought price was going to go here. I'm going to give you all of that.
Okay.
how you can
Okay.
start looking at that. But a simpler way to look at it is if you look at, for example, the weekly chart and draw your trend line. So the trend line is your area of value. When you hit the upper boundary, that's an area of value where it could reverse. When you hit the lower boundary, it's another area of value where it could reverse. That's a simpler way of looking at it. Another one is support and resistance. When price comes to support and price comes to resistance, they have a tendency to reverse. But today I'm going to show you something about these trend lines, support and resistance that not many people talk about. And I want to help you get out of trouble with support and resistance. So we'll focus on that as well.
Okay. Thank you.
Yeah. So that's what I mean by area of value, and you will determine area of value based on that. So it's a lot of it is price action. What is price telling me? Is price coming to an area a lot of times? And if I answer yes to that question, then that becomes an area of potential value. And then based on that value, I wait for break of structure to enter the position. So you don't want to break the main structure. You want to break the structure of the lower time frame, right? Your trigger time frame. Because if you're in an uptrend and you have a pullback, then your lower time frame is in the opposite direction. And when that opposite direction breaks structure, meaning it goes back to your longer time frame direction, that's when you enter. So that means you broke the pullback structure, which is a fantastic thing. That's what you want, right? When price comes and tests these areas, this pullback, break of structure, gives you confidence that it's going to continue to go up. So that's what I mean by break of structure. So again, the break of structure, what it tells you is, are the bulls or the bears taking charge at that specific area of value? And when we go into area of value, it will make a lot of sense to you. And so I did mention, area of value is horizontal or trend lines. These are your support resistance lines, whether you draw them horizontally or diagonally. Or you have dynamic support and resistance lines, which you get from moving averages or Fibonacci retracement. Moving averages, I barely use them because they're so lagging. I don't want to clutter my charts. But these are some possible areas where you could look at, okay, price moved away from the 21 period average and it comes back to the 21 moving average. It moves away, comes back. So you can use that as a dynamic support and resistance area. And we'll start to draw some support and resistance on various charts. So what that helps you then is find the highest probability of success by minimizing your risk and maximizing your reward. That's really what it's about to find our entry. And I've already mentioned, you want to see that pullback break structure, whether it's a pullback or a breakout with some confirmation. That's what you want to see to say, okay, I am at an area of value. I am terminating that area of value and I can enter my position. And in the same way, as you enter, you also have to decide, okay, as I enter spot X, if I am right, that structure is going to continue in that longer time frame structure. If I am wrong, the structure is going to continue to break and I have an exit. And so my exit is a stop loss. It could be a set amount of target, or structurally, if I go from the low to a high, I hit the high. So if I get a pullback, my target one would be near the recent highs. So I want to target those swings. That way, I'm not blindly entering a trade hoping it goes up $10 when there's a headwind at $1.50. If you know that, then you'll place your trade expecting to get out at $1.50, at least target one, meaning about 50% of my position I always exit at target 1. The other 50% I scale out in 2 other phases, 25% at target 2, and I let the other 25% ride as high as possible, but I'm always moving my stop. As price moves, my stop is moving from break even to target 1 to target 2. Price continues to move up until I either get stopped out or it's an end of day and I don't want to hold a position overnight, I get out. So very critical that as much as you have figured out where to enter, you have to figure out where to exit if you're right, where to exit if you're wrong, because both of those conditions could happen. And the reason why you do that is you want to get paid when you want to get paid, not when the market wants to pay you. Because when the market wants to pay you, they will pay you negative amounts because they want to take your money. So just get this in your head. I am going to get paid when I want to get paid. Meaning I have a target, that's where I want to get paid, I'm going to take my money out. We get greedy, we say, oh, it's going to go up further, then the market decides they want to take our money, then they take the price the opposite direction and take our money. So just always remember this. Get paid when you want to get paid, not when the market forces you to get paid. All right. So I am going to skip this next part because it deals about fear and greed, and I can come back to it for further questions. But I really want to focus now on how do you find area of value. Tracy, I think that will help answer your question, because when you find that area of value, then you can decide, okay, is there some sort of a break of structure, and is there something that tells me something is a stronger support than others? And so what I mean by that specifically is, if you take a regular support and resistance, if you say this is support, then I say this is support, and I draw again, this is support. If I draw this and then price decides it's going to slice right through it, then it was not a strong support, right? So it was a weak support. So how do you find the best spots for these supports that are the strongest? This is what I want to talk about in the next few minutes. And these areas, there's this concept of an order block. There's a concept of demand zone, supply zone, meaning the institutions, because they're the ones with the deep pockets, where do they think the price has the most demand and where do they think the price has the most supply? When we're in a demand zone, that's an area where the institutions are accumulating positions. They're accumulating positions and they're going to take the price to the upside. When we're in a supply zone, they're dumping their positions. And this is where retailers with FOMO, they will keep buying when the institutions are dumping. And you don't want to be caught in that position. You want to be selling with them and you want to get out with them. So understanding, when you look at the chart, where's the demand zone, where's the supply zone, very critical. And understanding the idea of order block is where's an area where institutions are showing us sign that they're going to take the price in a different direction. And what institutions do is, you see this a lot in Forex, but it happens in every market, but in Forex especially you see it a lot. But if you have this knowledge in your SPY trading, it's going to be a fantastic knowledge to have. So what an order block is, institutions will take the price down to take it up. They're going to take it down a little bit and they're going to drive it up a lot. Or they're going to drive it up first to take it down a lot. So this is called an order block. This is where institutions put money to in one direction to take price in the opposite direction. If you can identify these areas, those start to become your area of value. Because what happens is they take the price up, they don't sell that position, and then they take the price down. So this first position is losing money. The second position is making money, but the first position is losing money. So the only way to recover the money that they're losing in the first position is they have to bring the price back up here. And that is called mitigation. They mitigate the risk that they have taken in the opposite direction, they close it, and that becomes your area of value. When they come back to that value, that's a strong support and resistance. That's why some of your lines hold and some don't hold, is because the ones that don't hold, they are not part of an order block. They're just there because price has been there so many times. Institutions know retailers are going to play around with these values, and then they will take advantage of the institutions. And what happens in those support and resistance that many retailers trade, there is this idea of manipulation. And what is manipulation? What is manipulation? I'll show you an example. Manipulation is when price is starting to make, right here it starts to make a double bottom. There are a lot of retailers that said, oh, we have a double bottom, price reverse, I'm going to enter long. And then there are those who say, at this line, price penetrated this the low of this bar, I'm going to go short. So the institutions are now manipulating the shorts first, because they show them, I'm going to show you I'm going to go short, but then change my mind, so they get stopped out. Manipulation number one. The manipulation number two is these guys that went long here, they want to capture their gains way up here, so their stop is a little bit below here. They're waiting for those gains to happen, and then they bring the price back down. The institutions already had the intention to bring the price down here. They just wanted to manipulate two sides, collect their money before they really take the money down. So when you understand the idea of manipulation, this particular one, you don't see it very clearly, but there are times where you see it. They will come to an area multiple times. They go down, they go up. They go down, they go up. You'll see it multiple times, like in this case. You'll see it multiple times. They came down here. People who went short, they got taken care of by these bars. People who went long, the very next bar started to go in the opposite direction, and they got taken care of by these bars. They go short again. Nope, we're going to do it one more time because they saw some liquidity. They will come after that. Institutions know where our stops are. They have that information. They don't know where my stops are, but they know collectively where all the stops are. So they go after the most amount of dollars that they can take out of the market. So when you come to support and resistance, it is really critical to understand, could I be at a liquidity area where I get manipulated out, and do I just wait it out? And for me, what I like to do most of the time is when I see this break, I don't enter right at that break. I let price come down here, retest that area as resistance, and go back in this direction. This is where I enter my trade, because now they have already manipulated any retailer out of their positions here. In this instance, because they made they touched it 3 times and they continue to drive down, then you could also enter here confidently, because they started to close below that support line. So this is why understanding an area of value is critical. Where is price coming, and where could institutions be potentially trying to take advantage of you? So now that you know this manipulation area, and I mentioned a little bit about order blocks. So one more thing I will also mention, and then I will start to put them together. There's this idea of imbalance. what an imbalance is between 3 bars. For example, on the uptrend, the high of bar number 1 and the low of bar number 3 have to match. When they don't match, there is an imbalance. So what do I mean by they have to match? If you look at, I want to show you one on the bullish side as an example. If you look at this bar here, the high of that bar and the low of 2 bars after it, they overlap. So there's no imbalance there. But if you look at the previous one, the high of that bar and the low of the 3rd bar, there's a small imbalance. But 2 bars later, they closed that imbalance. So every imbalance, they will try to close it, because that's the algo traders, these computers, they go in and they get confused, and they will go and do their trades to close these imbalances and take the trades in whatever direction they want to take them. So on Friday, when market got up on Friday, we created this imbalance. This is why I was confident this morning to say, if price wants to go down, it's going to go close this imbalance. And that imbalance, if you have taken it somewhere here, 421 area, you went from 421 to 418. That's a very, very nice move on the SPY, especially if you're doing options. You don't need a Tesla $100 move to make a ton of money. You need a few contracts of the SPY, and then you'll make a ton of money. Was there a question?
I have a question.
Sure.
Oh, that's me. Okay.
Yeah.
So I do SPY and I buy for the expiration date same day.
Okay.
So today it was very tricky because SPY to me looked like it was a puts day. Great. But when it started off, it kept going up. And I actually, when I bought in, I was in the profit. Then it never looked like it was going to give me much profit. So I sold. I took that profit and then I came and I jumped back in. I was like, it kept going up. It hit like, I think close to 422.50. And I was like upside down in my contract, but I knew the lunchtime dip was coming. The lunchtime came, it was still like not in the money. And it wasn't until maybe after 1 o'clock that it started dropping. So I guess my question is, can you kind of explain what happened today? Because today was very tricky. You kind of did explain a little bit like what happened, what they were doing, but it was kind of very tricky today because it was really going up. And then maybe about 1:30, it just dipped all the way down to like 418. And I was like, man, and I had sold.
Yeah. So this is why they trick us, right? That retailers get tricked. And for me, when I enter a SPY position, I have a 25 cents stop loss, especially if I'm doing weekly. Like if I do a Monday, a Wednesday, or a Friday expiration, I have a 25 cents loss. So my tolerance says, if I enter this as a put position, and if price does not go down immediately, I am wrong. I want to get out here. I can re-enter, but I want to get out here at 25 cents per contract loss. Otherwise, if I keep waiting, what if price does this, right? Then my whole contract is going to be wiped out and go to zero. And we will never know where price is going. We just anticipate where they want to take it. So today, when the first 15 minutes was a down bar, here's another thing that you will like as well. And if you have a chance to listen at the video, you'll hear me say this. I said this first 15 minutes has a headwind at this line here. This line being the 15-minute range of Friday. And look at where this price came. it came close to that line and reversed. So I knew not to enter here. Why? Because from 421.60 to 420.81, I did not feel was enough of a gap for me to enter a position and capture profits. I want to see at least price be able to move $1. That way, even if I capture half of it, I'm in profit. Otherwise, price could move half and reverse quickly. And this had only an 80 cents gap. By the time you enter, that gap is maybe 60 cents. So I didn't feel comfortable. So that's why I look at previous days, where is strong support resistance. And the 15-minute range for me has always shown me it is a strong area. You can go back over and over to charts and it will go there and it will stall. It will go there. Here, it came down to this mid-range, it stalled. It tried to go to the bottom here, it stalled. So it always does that. So once you start to know your ticker, in this case SPY, because I will focus on SPY, Qs, IWM, diamonds. This is the only 4 things I focus on to day trade. So if you focus on these 4 and you start to learn their patterns, how they move and when they move, then you realize, okay, this was a headwind here, so I didn't take this position. And then up here, not to take the reverse for me, this yellow dotted lines are VWAP. VWAP represents the volume weighted average price, and it says for today's trade, most volumes happen at these values. Volume wise, this is the price where most trades took place as an average. So when that is showing me weakness, when price is having a hard time breaking through the 15-minute range, when it's having a hard time making a new high, because that high was contained within the first 15-minute high, I knew this was another entry to the downside. So this is why you can take a position, like I took a position from $1.03 to $1.25 to $1.50, and then I could not monitor the trade anymore, so I got out of my last quarter position with a very tight stop, because I was in meetings, so I couldn't monitor this part. But that's why it's important to understand your tickers and understand what are some of the areas where they stall. And they stall at the previous day's 15-minute range. 15-minute range is very easy to draw. You just go to a 15-minute bar, and the first 15 minutes of the trading day, draw a line at the top, draw a line at the bottom, and draw a line in the middle. For me, I have that automated. I have a script that just does it for me. But you can just draw it manually, right? Draw a line, 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 and price will respect that. And then draw your imbalance, and price will come to that imbalance. I have removed some of my imbalances, but you would have seen every time I draw an imbalance, price wants to come and close that imbalance. Like in IWM on Friday there was an imbalance up here, left from the week before, and that's why I mentioned on Friday during the video, I said, hey, if price pushes, it's going to stall at this imbalance. And when you see an imbalance, that's where price stalls. So there was an imbalance here. Today, price pushed, and you see it stalled at that imbalance. It does not mean it doesn't reverse and continue to push down, but at least it was a momentary stop. It stopped price from going down. It took care of that imbalance. It formed a lower high, because high, lower high, lower high, low, lower low, lower low. This was your confidence to enter here. What I want you to do is enter when you have the technical signals to enter, and not enter on something like, oh, it's lunchtime, it will break, because sometimes during lunchtime, a few institutions will decide they're not going to take a lunch break because they want to do something opposite of what the retailers are expecting. So if we just look at the technicals, we have high, lower, high, lower, high, lower, low, lower, low. We just broke that low. I can confidently enter. And 15 minutes is, for me, is decent because I don't have to look at the charts all day long, right? I can do my work. I can have this chart on the side. I can do my work and just every 15 minutes glance at it. And if 15 minutes is too much, for some people that's too much, you can go to 1 hour chart. And every hour, just a couple of minutes, you can take a glance at the chart. And here you have, double tops and price is breaking structure. And I'm going to enter here and target the imbalance. If it gives me more, I target some more. So that's how you can take a look at it. Now, let me add the final piece to this puzzle as we bring it together. So the yellow area I showed you is an imbalance using the 15 minutes chart. And then I have this green zone and then this blue zone. And the difference is the time frame. The blue zone is an order block created at the hourly chart. And as a reminder, an order block means they will take the price down before they take it back up. And once you see that, you see it after the fact, but that's okay. We want to see it after the fact because we want price to come back and mitigate that place. So in the green, I will draw those green ones using the hourly chart, and I will draw the blue ones using the daily chart. So the one here that you see is price came down. You have that down bar. And then from that down bar on January 4th, from that down bar, price just kept going up. So as soon as this structure is broken up to the upside, price keeps going down, I draw this order block. And I know at some point they're going to mitigate this because they don't take a stop loss. They have deep pockets, so they don't take a stop loss. Their positions on the long side, volume-wise, are much greater, so they're not even operating in margin. They have a much greater gain here than they do loss here, so they're covered. So from that perspective, they have nothing to worry about. But I know they're not going to close it at a loss. They're going to, at some point, come back and close this. So this becomes, for me, on a daily perspective, this becomes a very, very strong area of value. If I draw an order block and price comes to it, I'm paying attention, right? This is how you know this is very strong. A line is just liquidity to them. Liquidity where they will manipulate retailers. I'm going to show you down, I'm going to take it up. I'm going to show you up, I'm going to take it down. That's what they do with liquidity. And I'll show you a good example of liquidity using, I think I can use a 15-minute chart here on Netflix. So on Netflix, I might even be able to use an hourly chart. Yes, on Netflix, after earnings, price came down and they created this big imbalance. And so what they did was they played price within here. To me, this is a sign of them trying to accumulate more positions because they want to eventually take the price back up and close this imbalance, take the price back up. So they're going to accumulate positions here. So what did they do? When price touches these areas of liquidity, they will reverse it, stop people out. When price penetrates through and people wanted to go short, they will reverse it, stop them out. So these areas, support and resistance that we draw them, that we are in love with, these are areas where they manipulate. We think, oh, we got it right here, we got it wrong here. No, we were lucky here, and here we were not lucky because we didn't wait for that manipulation to take place. And the only way you would know this manipulation is over with, when they show you a new low, you don't enter. And so they show you a new low, but they didn't continue to take the price down. They didn't use this as resistance to take this price down. This was no go here. Same thing a day or so later. They made this, but they didn't use this to go here. They actually reversed price. So because we're not patient, we want to enter here. I want to capture the maximum amount. I will enter here. But this is where they screw me because I'm trying to be greedy. But if I wait for the last price to tell me it's really a reversal, then I can take that position. So you can see as an example here, when they close below this area of manipulation, this liquidity support line, and then price use that as resistance. And if you had entered at the break, so if you see this break of structure here, if you had entered here at the break of these lows, then price moved nicely for you. Price from these lows to the low of the day moved $7. $7 in Netflix is a pretty good move. I'm not saying you should trade Netflix. I'm just showing you an example of why it is important to look at area of manipulation. And once the manipulation is over, it gives you a clear direction. I am done with the manipulation. I'm going to give you an entry. If you look at this day here, on May 3rd, people thought, oh, you know what? They were consolidating and it's a breakout. I'm a breakout trader. Oops, I'm going to fake you out. The next hour, I'm going to take your money. Because these people got manipulated out of their positions because they thought they could go long at a breakout, but price reversed immediately. Why do I know? Why did I not enter this? After this break, I want a price to continue, test this high, and reverse. This is my entry. This is how you know the structure is broken. The momentarily downward structure, the only way it is broken is to make a higher low and make two new higher highs. That's the only way the structure is broken. Otherwise, the structure is still intact. If it fails to make a higher low, then this is not a good entry. This is how you know that the structure is not broken. So very, very critical when you come to an area of value, like an imbalance or an order block, to say, yes, this was an area where all the manipulation is done, and I can safely enter this position because they have given me a good sign of break of structure. So we have a high, a lower high, a lower high. There was no clear indication that this was a long position. But just because it bounced from the support line, this area of liquidity manipulation, there are some people who took this position. But what happened? That same day, that position was wiped out. So I'm hoping I'm not scaring you, but giving you some good nuggets on how you look at support and resistance.
Yeah, this is very helpful. Thank you.
Yeah. So going back to the SPYs, the difference between then the hourly and the daily order block, when you look at an hourly chart, then you draw that order block from that hourly chart. What does that mean? The last bar that went down before price reversed up. So there was one here. You could also say there's another one here. This is the last time price went down. I changed my color here to green. So the last time price went down, it reversed up. So now my next target then, if price continues to come down, is that I have this imbalance here, I have this order block here, and then I have this order block here. These are my potential targets as price continues to go down. I am not entering a position saying, oh, it has to get here. Nobody owes me anything. It doesn't have to get here, but it might get here. And the other thing is this last order block that I have drawn, a few hours later, it has been penetrated, right? This bar here at 6:30 a.m. Pacific on May 6th has penetrated this order block. The institutions might have considered this mitigated because they have almost no loss. They started up here, they actually went below that line, so they might have taken their positions off. So if I see a price penetrated, I had left it here as an example, then I remove this order block. This order block doesn't exist for me because that has been mitigated. So I want to see if it's not mitigated, it becomes a strong area of support and resistance. If it hasn't been mitigated, but if it has been mitigated, then I just ignore it. So that's what I want to look at. And so that's why in today's chart, when I have seen an imbalance, I knew we were going to target that imbalance. Tomorrow morning, depending on where price wants to go, I will look at the ES in the morning. If the ES says at 5-10 minutes before markets open, if ES is down here, then I know that they're going to take care of this imbalance when the market opens. If ES is up here, then that means this imbalance is left hanging for now. Because they have an order block, they know they're going to come back for it later, and there's no loss here for them. It's just an imbalance that they need to cover. Their loss is from this position here, because this position here, they have gone short. They have gone short to take the price up, and so their short position is in pain now, but their long position is in much greater happiness, so they're not losing money. Plus, they're already bringing the price back down. They've already sold their long position up here. They've already collected their money, and now they're coming back down to collect what's remaining. It appears to me over the next 2 days they're going to come and collect this. I could be wrong, but I only trade what I see, though. So I don't trade what I feel. I feel they're going to come here. That's not my trade. But, it's just something to look for. That if price continues to go down, just be aware that the 315.50 to 317 area could be an area where price reverses. So this is how I look at the markets. And so when you look at support and resistance, why do some work better than others? So hopefully I have answered that for you. And in an uptrend, we focus on demand zone, meaning there was an order block, price comes down to it, and there was a consolidation like I showed you on the Netflix. That becomes your demand zone to go up. Or in a down trend, we focus on supply zone because price comes back up for a little bit, and that supply zone price reverses in my direction again to go to the downside. So that's what we want to focus on. And just to help you understand, a demand zone is an area of consolidation before price makes a wild move to the upside, and the opposite is a supply zone is an area of consolidation before price makes a move to the downside. And we've talked about order blocks, the last down price before price pushes up, or the last up bar before price moves down. And I don't know if you have heard of the Wyckoff chart, but this is what they talk about in Wyckoff. They talk about there's accumulation, price moves, there's distribution, price moves in the opposite direction. You can have reaccumulation, redistribution in the meantime, but where they trick people is price has been doing this, and it got here, and so now retailers are thinking, oh, I missed all this move, so at this break here, I'm entering short. But you know what? The institutions are taking the price this way. So you have to understand if an area of consolidation is in front of you, do not just blindly enter it just because you think it's a bull flag or bear flag. Could it be an accumulation? Could it be a distribution? So keep that in mind. So accumulation would be your demand zone, and your distribution would be your supply zone. So keep this in mind as you're considering this. Kelly,
I have a question.
Yes.
So I experienced this afternoon with high frequency trading. I was looking at NZD USD. It was in a nice consolidation zone, and then it broke to the downside. So then it went into a demand. It went into a downtrend supply zone for that one, and it did so by sending out a big, huge red bullish candle, and then it just sold. It just dropped like hotcakes. So when you're saying this, going back to that chart that you were in just a little bit ago,
Yeah.
how you were showing the consolidated market, when it's consolidating, yes, in the beginning right there, when it's consolidating like that, how do you know if it's going to go to the upside or go to the downside? Is that when you go back and look at the EMA from an hour or two ago?
No, I don't. Like I said, I don't look at moving averages. I don't
Okay.
care about moving averages because they're already telling me what price has already told me an hour ago. So what
It's already there. Okay.
it's already
Okay.
there. So what you want to do, and look at this area right now. Let's look at this area.
Yeah.
So price came down, and then it immediately reversed to make people think we are going to make a V-shaped recovery and it's going to go this way.
Yep.
But no, they're going to keep taking the price down, and then so those people get stopped out. Then these people say, oh, it's a downward move. They enter, they get stopped out. So then they play the price here. And then they do one final push outside of the support area to make all the retailers that were stopped out along this way to say, oh, now this is a real down move. And you take that down move and price reverses, never seeing that price again. So the way you know that this area is completed, in an accumulation phase, they'll have this thing called terminal shakeout, which means it goes lower than the accumulation area, the consolidation zone. Price reverses, but it never comes back down. It just keeps reverses and makes higher lows. So as soon as you see one higher low, two higher low, that's your entry. This is the true break of structure.
Okay.
Yeah. Without this, there is no break of structure.
That makes sense.
Yeah.
Okay.
Yeah. And so
once again, patience is the key. Once again, okay.
Yeah. And watch for the save break of structure. Same thing on the opposite side, right? They will fake you out to make you think it's going to go long, because all the people who said, I've missed this move, I'm going to enter here. I'm a breakout trader. Good luck for you, buddy, because they will immediately say, nope, you're not a breakout trader. We're going to take out the price down this way. So you see a break of structure, lower high, second lower high. For me, this is my safest entry. Wyckoff said you can enter at E1 or E2 or E3. E3 is the safest, because they're not going to take the price back up. This way, they're done doing that. It's going to go down.
I see.
Yeah.
I see.
Yeah. So
Thank you.
Yeah. So when you're trading it, it's not easy the first time, but once you do it enough times, so here's your kiwi. So what time did you say you wanted to go long?
This was I was doing high frequency trading. I was only scalping like for 2 minutes.
Okay.
So this was back around maybe 1:30, 2 o'clock.
So 1:30, 2 o'clock. New York time.
Let's see.
New York
if you
time.
Go back, I'm on Eastern Standard Time.
Okay. So 11 would be so here. Oh, I'm looking at it already though. So 11 o'clock.
You were right. You were right there, and it's continued to go down.
Yeah. So this is
what was consolidated right above those parabolic dots.
Yeah.
Yep.
Right here. It
Right
consolidated here.
Yep.
Yeah. And then it gave you. So look at this. Look how beautifully they played out what I showed you. It broke out of this.
It did just that. That's it.
And then people thought, I'm a breakout trader, I'm entering. Nope. It immediately reversed. It consolidated again, and it reversed. It never saw this price again. It never saw this area again. This is when you know you have a safe entry. Right?
Okay.
If you're in a hurry to enter sometimes you are right. Like if you had seen price came up here, it reversed, so I'm going to enter here, right? This let me draw it better here for you. If you say I'm going to enter right at this bar here, you are right, price went down, but not before it gave you a lot of pain and stopped you out, right? That's why you want to see break of structure. Being right is half the equation. Break of structure is the other half of the equation.
Okay.
Yeah.
I'm getting that. This has been really, really helpful. I really appreciate you taking the time
Of
to
course.
show us this tonight. I appreciate it.
Of course.
Thank
Of course, this is why I do it. I get my pleasure from helping people. So I've said a lot of things. I'm pretty sure I have muddied the water even more. But, what questions do you have?
Okay, I see you use TradingView. So, you pay for your subscription? I'm quite sure you do. That's not the free one, right?
So TradingView free gives you just one chart. I can do multiple charts. Like I can have in one layout multiple charts. I can have multiple layouts. So I do pay for mine. I have the Pro Plus subscription. And then I also pay for the data feed because I want to get real-time data. Data is cheap. I pay $10 a month for data.
Okay.
I
use
Yeah.
Thinkorswim. I have looked at TradingView, but so basically, your chart looks different. So those lines, I know you said you can draw them, but do you have did you go in, like on my Thinkorswim, I went in, I put the Bollinger Bands and different things on my chart.
Yeah.
What have you added on this chart? What did you go into your settings and add on this chart so that you can see the different resistance levels?
Okay, this 15-minute range bar.
Mm-hmm.
This is OR 15-minute bar is something that I coded myself. So I have the code for it down here. That's what I used. So and then I just add that. The yellow dotted lines are VWAP. That if you are a paying subscriber to TradingView, they allow you to use VWAP.
Okay.
I have no other indicator on here. Everything else is, if you see previous HLC, for me I draw dotted lines to tell me where was yesterday's high, close, low, where was last week's high, close, low. And then day of week just tells me this is Friday, this is Monday. This is just something, because I do a lot of videos, sometimes I forget if I'm talking about a Monday or a Tuesday. So I just like a reminder there. So this one is not really important.
Mm-hmm.
Yeah.
Okay, so those lines, the red, green, and the white line is from your script that you coded.
Yes.
Okay, I see.
And this script, remind me on Facebook. I can give you one for Thinkorswim. I have the same script for Thinkorswim.
Okay, that will be helpful because on Thinkorswim, I was told today before this meeting that I needed to go to the either the 15-minute, 30-minute, or 1 hour, because I was looking at 5 minutes, and and someone was like, "No, don't look at 5 minutes because that's too soon, and that's what's making you jump so quickly."
Yeah.
And they were like, "You need to really stretch your time out because you're seeing." Like I said, I was doing puts, and I started seeing the green candle, and I was like, I'm just gonna take this profit and go.
Yeah, that's why when I do 15 minutes, two things: I'm not glued to the chart. I don't have to look at it all day long. And the second thing is, I want to see the structure of that 15 minutes. If I turn this to a 2 minutes, 5 minutes, I know Chris likes 2 minutes. He's great at using the 2 minutes. But I'll get scared shitless. Sorry for the language, but if I look at the 2 minutes and I say, oh, break of structure, 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 I better get out of this position. But if I had looked at the 15 minutes, I would know there was only one break of structure, and that is not even one that has breached the high of the day. So I'm okay to not be afraid of this position. But like I said, for me, I did not take this entry here. I took the entry a little later because I wanted this headwind to be out of my way.
Okay. Well, actually, Chris is the one who said, yeah, go to 15. When he does SPY, he says 15, 30 minute, and 1 hour.
Yep.
So, yeah.
Yeah.
Thank you.
Yeah, of course. What are the questions?
Okay. So I do have another one. Now, I like to buy my contracts right when the market opens because they're cheaper. Because I like to buy a lot of contracts. So is my strategy, and it's been working for me, is that, a good strategy? I like to look at them at 8 and put my bid in so that when the market opens, they execute.
So let me show you something that will kind of answer that question and see if you will answer it yourself first. I will show you the previous week, Thursday, was a beautiful, beautiful example to answer your question. So the previous week, Wednesday, price closed at 417.35. The following day, it opened at 420.33. So during pre-market, you probably said, hey, it's a gap up, I'm going to buy call options. And what did price do? It collapsed. It closed. There was a huge gap. If there's a gap, it wants to close it. It might not close it immediately, but it wants to close that gap. So if you had bought a call option at 8 a.m., put in your order, get me a call option right at entry, then that's a loss right there. But if you wait for 15 minutes, let price tell you what it wants to do, it showed you after 15 minutes, I'm going to break out of the lower end, I'm going to keep going down. It showed you that already. But the first 15 minutes doesn't show you that.
Do you think that SPY follows NASDAQ?
They all follow IWM. Let me put it this way. IWM is small caps.
Mm-hmm.
So they don't follow it day for day, but if IWM is strong, over 2-3 days, and if SPY was weak, it's going to catch up and be strong with IWM. So IWM, for me, I use it as a leading indicator.
Okay, I use NASDAQ as my leading indicator. So actually, if NASDAQ is showing me it's down, I don't care if SPY is showing me it's up. I'm following NASDAQ. So I actually did not buy calls on Thursday because if NASDAQ is showing me it's down, I'm following NASDAQ. Yeah. But now I'll be looking at IWM as well.
Yeah. But not last week Thursday, but the week before Thursday, when you had a big gap up, it's tempting to think to go long, but that's why I say wait for 15 minutes, let the price tell you what it wants to do.
Okay. And I think the wait will be beneficial to me. I think I might try that tomorrow.
Yeah. And on Friday, let me show you one example on Friday. Friday SPY was up all day. Right? All day SPY was up.
Yeah, I did calls Friday.
Yeah. Q was up Friday, but not that significantly. So it's very hard to say just because the Qs are up, the SPYs will be up, right? Some days they will move in opposite direction because Qs are more technology heavy and SPYs are everything. So, but looking at all of them is not a bad thing.
Right, yeah. Well, NASDAQ was up, so, like I said, I just followed it. So NASDAQ was green, and I was like, oh, it's going to be calls. And NASDAQ just kept shooting up. they did have some drops, but it shot up nicely because actually it hit up to I think 423 and some change on Friday. And then at the end of the day, it ended at about close to 422.50.
Yeah.
Yeah. So I was like, okay, great. But okay.
Yeah. But so looking at where's area where institutions are going to come and manipulate you, where's an area where institutions need to mitigate their losses, seeing imbalances will help you understand where to go next. What else?
Nothing for me.
Anybody else?
No, this is very helpful. I'm very, very new, so I'm just, just having you walk through the charts and the indicators has been just invaluable. So I appreciate it. I just know I've got a lot more learning to do. So thank you. Are your other videos posted online so I can go back and watch those too?
So I'm going to selfishly ask all of you to subscribe to my channel. So I just put it in the chat section.
Oh, okay. I will subscribe.
No, because